Dear viewers, the new year has begun on not such a great note, especially for small caps. The benchmark index of BSE Smallcap index is down about 9% from its peak. However, the pinch has been harder. A good number of small caps have corrected 20% and even more. To be honest, this was long due. Just before the correction, a huge anomaly was seen in the markets. The small caps were trading at a significant premium over the large caps. The median PE or price to earnings multiple for the small caps had risen to 34.5 times. This compares to 24.5 times PE for large caps or for top 100 stocks by market cap. It neither makes sense on an earnings basis nor on a trailing earnings growth basis. In fact, as per the latest financial stability report by RBI and Bloomberg estimates, there has been a huge gap between the estimated earnings growth versus the required earnings growth that can justify the valuations for Nifty Small Cap 100 Index. As you can see from the chart here, while this gap exists across market caps, it is the highest for small caps. In other words, the valuation for small caps were expensive even if you factor in the future growth. As such, recent corrections are not surprising. A lot of popular stocks are trading at expensive valuations with a PE of 50 or 70 becoming a norm and not even raising eyebrows. As you can see in this table, of around 3,000 stocks, over 50% trade at a PE of 35 and above. This is significantly higher than the benchmark index PE or long-term median valuations for the Indian market. Even within the small caps, it is the stocks riding narratives that are likely to face a big correction in case the broader markets correct. You see, a lot of stocks riding big themes are priced to perfection, leaving no room for slippage in execution or growth. As the recent quarter earnings suggest, the slippages will be norm rather than exception. Still thinking of paying up for that growth story? Well, here is a simple grid that can help you make better buying decisions. Let us say you are okay investing in a high growth stock which is trading at a PE or price to earnings multiple of 75, hoping that the trend will remain a tailwind and undisrupted for the business in question. Let us assume an exit PE of 40 times after 3 years, which is generous relative to the benchmark index PE of 20 times. Now, to make a minimum 15% CAGR return on the stock, the company will have to grow its profits at 42% CAGR over next 3 years. Now that's a tall ask for many high-flying stocks. Any slippage, in fact, is likely to lead to PE derating, which could lead to underwhelming returns on the stock or even losses. A case in point is Zomato. Weak consumer sentiments have impacted gross order value in the food delivery business that has grown at a muted 2% on a sequential basis. The irony is that this has happened in a festive season. Zomato's quick commerce business is far from break-even. The right economic model is still being figured out. With more investments here, it is likely to be loss-making in the foreseeable future. And then there is a high competition in these businesses to factor in, which are disrupting the disruptors. The correction post-earnings report should not be surprising at all. At these valuations, investors are not ready for any slack in the business performance. While this is just one example, I believe investors who have ignored the margin of safety in valuations are likely to go through more pain and more negative surprises. Bottom line is, entry valuations matter. Now, I do not know if the markets will rebound soon or if the correction will be deeper. That is something to bother about if you invest with a short-term horizon. However, if you're a patient long-term investor, any correction is likely to offer you decent bargains. In the meantime, a prudent asset allocation will not only limit your downside in the market correction, but will also help you use this correction to your advantage. As such, preparation and not panicking will be the key to long-term wealth creation in this market. Hope you found this video useful. For more such updates, subscribe to Equitymaster YouTube channel. Thank you for watching. Goodbye.